and a very warm welcome to our clients and the many other business owners that have joined us today. By attending this webinar this morning, business owners and managers will gain a basic understanding of what management accounts are and the purposeful and critical importance of actually producing them regularly to aid in making solid financial decisions and to resolve troubling trends and risks before it is too late. Now, my name is Monique Sharland. I am a qualified professional accountant and founder and CEO of Business Accounting Network, or better known as BAN, a national franchise of accountants that has been in business for more than 18 years. Personally, I specialize in business advisory, tax law for the small and medium enterprise sector, and I'm also a franchising expert. And our approach to the services our nationally based independent accountants provide your business has always been about encouraging you to invest proactively in financially managing your business well, together with maintaining compliance and mitigating against tax risk. And now we'd like to return the favor with a little investing of our own. As accountants and business owners ourselves, we have seen the need to orientate, educate, and motivate the smaller business sector as we are committed to business success in South Africa. Now, many small business owners do not know or understand the value that management accounts can provide, thinking that their business is too small to warrant the perceived cost. And to be quite candid, the cost of producing management accounts is really a myth. Many small business owners are quite mistaken and very much at their own peril, because the benefits derived from management accounts should always exceed the cost of producing them. And the reality is that this is 100% achievable for any business, whether you are a micro business or a small business. In terms of the Companies Act and the Close Corporations Act, which Madeleine Pretorius, our franchise business based in Paarl, covered in the last 3 webinar sessions, it's a criminal offense not to keep your accounting records up to date. Now, criminal charges of this nature are likely to be laid against directors and members and even sole proprietors in their personal capacity, and that would be done usually by creditors. Now, given this legislation and that micro and small businesses need to keep accounting records accurately up to date, it is these accounting records that are used to produce management accounts. So therefore, if you've got a competent bookkeeper that can provide complete and accurate accounting records, this saves much time on the additional accounting work required to be done by your accountant to produce the management accounts, because it only takes between 1 hour and 3 hours to do so. Obviously, depending on your type of industry you are in, the customization of those management accounts, and the nature of the disclosures that are required. It might take longer, of course, for businesses that have multiple stores or divisions they need reporting on. And another myth that many small business owners hold is that looking at a trial balance extracted from a general ledger is good enough. Now, management accounts are not the same as looking at a trial balance extracted from a general ledger produced by your bookkeeper. A trial balance is part and parcel of accounting records and cannot provide substantial information you or your accountant needs to analyze your business that will be useful to you. So if your business is your bread and butter, receiving accurate management accounts on a regular basis is essential, as your very livelihood is at stake if you work in the dark. And I'm sure that's a no-brainer. So as Shay mentioned, if you have any questions as we go through the presentation, please type them into the chat box, and I will certainly address them in the last 10 minutes of the presentation. Right, what are management accounts? First of all, management accounts are summarized financial information extracted from the accounting records, as I mentioned earlier. And not all management accounts will be the same. They are tailored specifically for management and their needs, decision-making requirements, and also the nature of the business. So, for example, a retail business will need to see records of inventory, whereas a service industry would need to see records of margins and productivity of their employees. Management accounts are prepared at regular intervals, either weekly or monthly or bi-monthly if it's a very small business, in line with when the VAT returns are due, or quarterly. So most commonly, management accounts are prepared and presented on a monthly basis. Specifically, the management accounts are produced for the business owner or manager and is not usually produced for external users, only perhaps the bank when requested, but it is specifically for the use of the business owner themselves. And information supplied by management accounts must, first of all, be done timelessly and accurately to be useful. So the accountants in Business Accounting Network will not produce management accounts if the accountant knows that they are either incomplete or inaccurate, because the business owners could perhaps take those management accounts to the bank for financing, and the bank will make the wrong decision if those management accounts aren't accurate. However, our accountants would produce those management accounts if the business owners do insist on them, but they would put a disclaimer on every page to those management accounts, pointing out the fact that they have observed that their management accounts may not be accurate. So producing management accounts, you will probably need assistance by your accountant to prepare them, as well as to interpret and analyze the information. And the accountant needs that kind of information from management accounts, which leads to the next really in-depth analysis, which we call business financial analysis. And that we will cover next month in September. So we shall be looking at a basic example of what management accounts should look like later on in this presentation. So what financial information should management accounts produce? So most commonly, they would include the balance sheet, or sometimes it's referred to as the statement of financial position. Now, the balance sheet is the most important report for your accountant to interpret the health of the business and whether it is solvent or liquid. And we will look at an example later in this presentation of what a balance sheet looks like. But basically, a balance sheet discloses two types of assets and two types of liabilities of the business. It will disclose the fixed assets that are necessary to generate the income for the business. So, for example, if you are in the service industry, your fixed assets you might very well need is computers to generate the services that you might provide, or vehicles to provide the services that you might provide. Current assets include cash and other assets which can be converted relatively quickly into cash. So that would be, for example, your customers and what they owe you. And if you're in the retail outlets, it would include inventory or stock. Liabilities, we have long-term liabilities or financial liabilities. And those are liabilities that are repayable by the business over a period that exceeds 12 months. So, for example, that would be installment sale financing over assets, such as a vehicle or a machine, and mortgage bonds. And usually it will also include any loans the business owes to its shareholders or members. Then the other form of liabilities is the current liabilities, and that is debt that the company owes its trade creditors, as well as other creditors, including SARS for VAT, payroll tax, and income tax, and the bank overdraft or any other short-term loans. And the income statement, which is sometimes also referred to as the statements of comprehensive earnings, reflects the monthly turnover of income of the business, as well as its cost of sales and its gross profit, overheads and tax payable, and net income or loss. Another common report should be cash flow statements. Now, cash flow statements are mainly produced from the financial information of the balance sheet. Cash flow statements are historical reports based on a summary of the movement in the bank account from one month to the next. And the cash flow statement records the historical cash in and cash outs of the business. And it's summarized into 3 or 4 main categories. The first is working capital, how the movement of working capital in the business. And working capital consists of what your customers owe your business, what inventory your business holds, less any creditors that the business owes. Then it also looks at the movement of fixed asset acquisitions and also the sale of fixed assets and how that affects your cash in your bank. The third summary is the repayment of long-term borrowings, which is paid out of net profit. And very often those long-term borrowings are things like mortgage bond repayments, installment sale repayments, as well as monies either invested back into the business by shareholders or withdrawn from the business by shareholders. And lastly, and most importantly, are also notes to the management accounts for the business owners or management to explain some of those figures in the management accounts. And any good accountant will always provide notes. Now, these notes are quite unlike annual financial statement notes. These notes are purely there to summarize the details of certain figures in the balance sheet. So, for example, the income tax, how that was calculated, perhaps a list of the age analysis of customers and how much they owe, and also the same with suppliers, how inventory figures were derived at, etc., etc. It's also to identify significant fluctuations in the income statement and to disclose to you, the business owner, as to why those fluctuations occurred. And also to identify basic worrisome trends in the management accounts and to provide some advice on recommended solutions. So what financial information should management accounts produce? We are also looking at additional information that should also contain up-to-date income tax liability to SARS. Now, when we often ask the question to business owners, do you know how much tax you need to pay before your accountant tells you that your provisional tax is due at the end of this month, August? Do you know way in advance how much tax you need to pay? Management accounts are inaccurate if it does not show your up-to-date tax liability, income tax liability to SARS. Also, comparison of business results or performance to your budgets or forecasts. Now, budgets or forecasts or projections, as they are sometimes known, all have the same meaning. They are estimated projections of monthly turnover, cost of sales, overheads, and income tax and profits after income tax. Budgets should be completed for at least 3 years in advance, and it is a critical planning tool for business owners as it provides essential figures to meet. For example, your monthly turnover or the income you need to meet monthly to cover your overheads, which we call break-even turnover. Things like loan repayment obligations. So budgets should build in growth strategies for the business to meet the business owner's lifestyle goals and to build an asset of value. Gross profit margin trends should actually be reflected in the income statement. It should not have to be manually calculated by anybody because gross profit margin trends is a very important measurement factor in management accounts. And when we look at an example later on in this presentation, we will show you exactly how that can be done. Then sales, which is turnover, expenses, which is your overheads, customers or debtors, and your supplier or creditor trends. Cash flow projection for at least the next 2 months. So this is not historical, this is projections going forward. Over the next 2 months, is the business able to pay its creditors when the payments become due? And then capital expenditure likely to incur in the next few months. Can the business finance that capital expenditure? So without management accounts, it would be highly unlikely that that decision could be made. So why do you need management accounts? So there are very important uses. First off, to make informed financial decisions. Informed financial decisions is a defense against the criminal liabilities that directors of companies and members of closed corporations are exposed to in terms of law. Key financial information that is up to date is vital for decision making because old information can lead to the wrong decisions being made. And real-time information, or as close as possible, avoids missed opportunities in your business and can make decisions when needed and not a few months down the line when information is available. Far too many smaller business owners only make decisions 18 months after their entire financial year because that's when they receive their financial statements. That is too late to be able to make an informed decision. That's not a risky decision. Also, the management accounts are used as a base required by your accountant to actually delve deeper into weaknesses as well as strengths of the business and to provide advice. Without management accounts, your accountant is unable to do the ratio analysis to provide business financial analysis and to provide advice. Up-to-date financial information on which external professional advice is based on. In other words, your accountant, as I mentioned earlier, is only able to provide the advice once they have management accounts and accurate management accounts at that. So also with regards to giving advice and making the right decisions, for example, you might want to finance a new vehicle in your business, or you might need to import a new machine. Without management accounts, it's going to be very difficult in order to find out whether the business can, in fact, afford those repayments. So up-to-date management accounts provide confidence in you as a business owner and your business to investors and bankers. And it also indicates a level of control and understanding by you over your business and enables you to obtain financing more easily. And it also enables the financier or the banker to consider your financial and accounting results more effectively, making a final decision. Also, with regards to planning budgets and identifying weaknesses and implementing strategies to increase profitability, if your accounting information is reviewed on a regular basis by your accountants, any errors or irregularities will be picked up and easily corrected. A regular review of financial performance also enables the detection of fraud or other malpractice, especially when you have employees. The longer the time gap between your financial reviews allows wrongdoing to remain hidden and more difficult to uncover. So regular analysis of management accounts enables you to recognize relevant trends in your business, comparison of actual versus budget expectations, and also corrective measures can be put in place if necessary, and it can be done so timelessly. If costs are increasing, for example, or sales are dropping, addressing those kind of issues 18 months down the line, unfortunately, would be very damaging for your business. Cash flow management is a very important use of management accounts because obviously cash is king in any business, and key is to know what your cash inflows and outflows are and when they will occur. And these are vital for cash planning and the survival of your business. So for example, excess cash in a business can be invested, or bulk discounts can be taken advantage of, or unnecessary purchases that put strain on cash flow could be avoided. Knowledge of cash flow also links to liquidity and solvency ratios of the business. And if management accounts are prepared and reviewed on a regular basis, problems can be sorted out at that time and not, as I said, at the end of the financial year, usually some 6 months after the end of the financial year, making it 18 months. And then it reduces year-end accounting costs when preparing annual financial statements by your accountant. Because most of the accounting work is up to date, the fixed asset registers are up to date, all the transactions have been processed, and it reduces the time in producing annual financial statements quite dramatically. And of course, tax planning, because management accounts need to be accurate and all expenses need to be taken care of, as well as income. And it's so much easier to have a look at tax planning as well as cash management. So you have the monies in order to pay taxes when they become due. Right, so how can management accounts be used to mitigate risk? There are some important risk management factors that every business owner should be aware of. First off, if you have a company and you are a director, mitigating factor for directors and members against criminal offences, because in the Companies Act and the Close Corporations Act, if you make decisions and they are uninformed decisions, obviously you are exposing yourself to potential criminal offences as well as civil lawsuits. So management accounts would be a mitigating factor on which you might have based a decision on. It can assist in the detection of fraud, and the business sustainability risk management is so much greater to identify and to correct. And a lot of the business sustainability risk management lies in internal risk factors, such as productivity, human resources, efficiency, technology and systems, perhaps risk factors with regards to suppliers, as well as customers, and acquisition or maintenance of assets. It also assists in the detection of what we call the death spiral of a business. And we will cover this more in depth next month when we provide an overview presentation of business financial analysis. But basically, a death spiral relates to a business that is growing, and as they grow, their profits are also growing, but so are their net assets. But their net assets are growing at a faster and higher rate than the profits they make. And we call that a death spiral, and it's one of the major reasons for business rescue. Cash flow management is obviously a huge risk if you can't manage your cash flow from month to month, and management accounts will certainly assist in cash flow management and also compliance with statutory regulations, and that is mostly SARS. And what we find as accountants is that small business owners very often use, for example, VAT to finance their business. And when VAT becomes payable, they are unable to pay over the VAT. And this leads immediately to a liquidity problem in the business. So management accounts will be able to pinpoint other weaknesses in the business in order that your creditors are paid on time. And lastly, but most importantly as well, is downward trends, which relate to personal factors. Now, downward trends are identified in management accounts and are additional factors that can affect business risks. Now, as accountants, we have found that they are sometimes caused by personal conflicts and complacency. So, for example, business owners balancing work with personal and family obligations, or high employee turnover, or business owners drawing out more cash than the business can afford to pay them. Complacency can also lead to missing opportunities for growth and increased profitability because you're kind of sort of satisfied with the status quo. So what accounting records are required in order to produce management accounts? So as we mentioned before, that accounting records are a legal requirement legislated in the Companies Act and the Closed Corporations Act, and for sole proprietors in the Tax Administration Act. The first set of accounting records is the cash book. The cash book records monies going into the bank account and monies going out of the bank account. Also, purchases from suppliers and how much you owe suppliers at the end of every month. Turnover or sales to your customers and how much your customers owe you at the end of every month. A journal is pretty much used by your accountant to bring in entries that do not arise either from the cash book or the purchases or the sales. And these would be entries like depreciation, finance charges, and so on. A fixed asset register, that is also a requirement in terms of law to be kept, and very often we find that smaller business owners are not quite sure how to maintain a fixed asset register, so you would more than likely have your accountant assist you with that. In an inventory ledger, and if you don't run an integrated inventory system, you might have to take physical stock take at least every quarter in order that your management accounts can be as accurate as possible. And all of these books lead into one big book called the General Ledger, and from the General Ledger, a trial balance is extracted. So these are all the accounting records that need to be maintained regularly, daily, or monthly in order to produce management accounts. Now, the completeness and accuracy of accounting records can't be stressed enough. And some of the entries that need to go into that general ledger that we spoke about earlier to ensure completeness and accuracy of management accounts are the following. The first is we need to provide for depreciation in the fixed asset register and bring that into the general ledger. The reason being is that we're going to be calculating income tax liabilities to SARS, because without that liability being calculated, your management accounts are useless. Secondly, finance charges. If you have any installment sales over assets or financing over assets, we need to amortize those finance charges and bring those in to reduce your expenses. Well, increase your expenses and reduce your profit, should I say. Then we need to accrue any expenses and entries of expenses that are paid from other sources. So for example, as business owners, sometimes we take money out of our own pocket and pay for parking, entertainment, whatever. Those entries also need to go through the general ledger. We need to account for prepaid expenses. In other words, expenses that don't relate to the current month but could relate to the next few months ahead, as well as income received in advance. For example, deposits that you might receive, it's not income at that point in time. So we would need to obviously allocate the deposits or any income received in advance. This is what we call a matching principle, where your cost of your sales and your income need to match in the month that you are reporting. Then if there are any intercompany loans or related party loans, they need to be reconciled with one another to ensure that we've picked up all the entries in both companies. And then, of course, the income tax computation needs to be calculated once all the above entries have been journalized into the general ledger. And once we've done that, we need to go through the balance sheet accounts. And if you recall, I think the balance sheet is the most important document or information in management accounts. So your accountant will reconcile balance sheet accounts either to supporting documents, like creditor statements, for example, or installment statements, or the bank statement, and to schedules that they might need to produce, for example, a prepayment schedule or a finance charge schedule. So now we're going to go and we're going to have a look at an example of what management accounts look like. This is the cover page of management accounts. And this is a fictitious company that we're going to be looking at. We're calling it Turnaround Consulting, PTY Limited. As I said, it is a fictitious company and it is a company in the services industry. So we're looking at a snapshot date at August 2018, so it will be monthly management accounts. And what's also very important in terms of the Companies Act is that the Companies Act requires any financial statements, and financial statements is in fact management accounts, that anybody that prepares financial statements must have the preparer's name on the report, as well as if they have any professional qualification, they would have to put the qualification there and the date that they have prepared the management accounts or the financial statements. So those are the two cover pages, and any good accountant, as I say, they need to make sure that they do comply with the Companies Act if they are preparing management accounts on your business's behalf. We get to the balance sheet. Now, balance sheets can be presented in a multitude of different ways, and it all depends on the importance of reporting to that particular company or that particular industry. So what we've done is, this is a statement of financial position or a balance sheet. And we've looked at the current month, which is, we're looking at August 2018, and we're comparing it with the previous month. But then we are also going to have a comparison to the same period last year, August 2017 to August 2018. And this assists us with cash flow statement calculations as well. So as I mentioned, your balance sheet consists of assets. Non-current assets is your long-term assets, for example, fixed assets, computers, vehicles, etc. We have a related party loan here, which means that that loan is only going to be repaid more than 12 months in advance. Then we have current assets. Trade receivables would be customers owing. Other receivables, that could be prepayments or anything like that. And cash resources would be monies in bank and call accounts. And we will compare later on between the results of the current month that we're reporting to the previous month, and we can also do the same to the previous year. Now we're going to look at the liabilities of the company, which is your shareholders' equity and liabilities. In this instance, we have share capital. So this company was obviously formed prior to 2011 because there is no longer share capital in companies. Retained income, accumulated loss. You'll see that in the prior year there was a loss. And then in July we had a bit of a profit, and we've obviously had more profit in August. So that looks like a good trend. But we'll have to drill down when we analyze those figures. Shareholders' loans. The previous year was 164,000. You can see that the shareholder is drawing out money because the loan has decreased to 127,000. And then we are looking at the current liabilities, and the current liabilities are increasing from 87,000 to 161,000 over the last 12 months. And they're made up of trade payables, which is creditors, other accounts payable, which could be usually SARS, VAT, payroll tax, those sort of things. Provisions. Now, provisions could be leave pay or bonuses. Then this also has a bank overdraft as well as money in the bank. And you'll see that there is a taxation provision here. That is absolutely imperative that there is always a taxation provision, because without, and that needs to be current, up to date, in other words, at the end of August. And I'm going to show you where, in the notes, your accountant or any good accountant will show the calculation of how that tax provision came about. You'll notice that there was no tax provisions in the previous month or the previous year. So this company is obviously going into a profit situation, hence the taxation provision. Then we move on to what an income statement should look like. And this is the statement of comprehensive income and retained earnings. You'll notice that you'll have turnover or your income, and there will be each month showing exactly what the turnover is. And you'll see that other than April, the turnover is increasing month on month. Then you'll need to have a look at the year to date as well, because that is very important in terms of comparing to the last period year to date. So you'll see last year's year-to-date and the current year-to-date, there has been a significant improvement in turnover. In this particular case, it's a service industry, and the direct costs related to any service industry, you're selling time, you're selling your employees' time. So your salaries should be reflected under direct costs. Here we've got some directors' remuneration as well, because directors' remuneration and members' remuneration needs to be disclosed separately in terms of law. And we've also shown here the provision of leave pay and also bonuses. So we come down to our gross profit. Now, I'm going to just increase this a little bit so you can see a little bit. So there we go. I think that should, you can see the figures better there. So here we have gross profit, and here's a very important measurement, and that's called gross profit percentage. And that measurement should be shown in management accounts, so one can actually see the trends of what is happening with the gross profit. And we have other income, like traveling expenses recovered, and this one's got guest and keynote speaking. Other income is not part of the main turnover of the business, so we would separate it. Then we've got profit before tax, interest income and finance costs that we pay. And then we get to net income or loss before tax. And here's the most important aspect, is that that tax amount must be calculated every single month. If we toggle to the right-hand side, year to date, the tax payable up to the end of August was 4,190 Rand, but that was not the amount reflected on the balance sheet amount. The balance sheet amount is the amount that should be in a savings account or somewhere where you've taken the cash and you've provided it separately in order to pay SARS when provisional tax becomes due. So any good accountant will always show you what the actual tax situation is in the business. And then, of course, what the accumulated loss or profit is at the end of the reporting period. Then we move on to budgets and forecasts. Now, here we display the actual figures that were achieved under the reporting date, which is August 2018, and we compare our budgets to our actual, and we have a look and see what the variance is for that particular month, and we give it a percentage variance. From an analytical point of view, this points out to us where there might be weaknesses and what we need to address. However, to analyze the year-to-date figures is much more useful than just analyzing the month. So accountants would usually focus on the year-to-date, actual performance to budget performance and variances, as this will certainly give some kind of direction in forward planning or future planning of the business. And in this particular case, there has not been massive differences in terms of the budget against actual. Then we have a separate schedule of overheads. And those overheads, again, month for month, what they are, year to date, and last year to date, so we can compare our overheads. And there should be pretty much a trend of what those overheads are. There should not be major fluctuations, because the rent you pay will always be the same. Your telephone account will pretty much be the same. Your insurance you pay should be the same every single month. You'll notice that there's no director's remuneration here. Now that already is a cause for concern. We have found director's remuneration under cost of sales, which was a very minimal amount, but we'll go back to that just now. And then we will analyze the expenses against budget. So exactly the same as the income statement that I showed you with regards to your actual for the month, budget and variance, and year-to-date actual budget and variance. In these expenses, minimal variances, 2.13% for that month, but overall 1.24% difference, which is actually very good. And then we get to cash flow or cash flow statements. And that is what a cash flow statement looks like, except I have only put in the cash flow for August, but usually you would find all the figures for every single month. It should be done on a month-to-month basis. So the cash flow statement starts off with net profits for each month. It adds back any non-cash flow items. For example, you don't pay for depreciation. It doesn't come out of your bank account. So we increase the profit by that amount. So in this case, you'll see in most instances in this business, we've got a profit. So we've got a profit of 16,844 Rand. And that profit, by the way, is after tax. So it's important to calculate the tax. We look at working capital changes. In this case, there was cash outflows out of the bank of 11,622. And those cash outflows were attributable to growing customers owing money to the business. Then we purchased some fixed assets. So there was some cash outflows out of our bank to purchase some fixed assets. And then we looked at financing activities. The financing activities, decrease and increase in shareholders' loans. You'll see that the shareholder in this instance has taken out 32,000 out of the business. And then we look at the net movement of the cash flow. Starting with the profit, the money's going out of the company or the business to finance customers, the money going out of the business to finance the purchase of fixed assets, and the whopping amount that the shareholder has taken out of the business for him or herself, which gives us a net amount of money that's gone out of the bank account just for the month of August of 28,000. We started off with a bank balance of 26,000 at the beginning of the month, but because the shareholder has taken out more than they should have, they put the company into overdraft of 1,394. Not a good sign, really. Okay, the next thing we spoke about is the notes to the management accounts. And what is very important is how the management accounts have been produced, what financial reporting standard was used. In this case, the tax or historical cost basis was used. That is very important for management to understand how the bookkeeping or how the accounting entries have come about. And I'm just going to toggle down just to some of the notes that can go into management accounts. You will notice that we would attach a debtors list, for example, or customer age analysis to show exactly what customers owe, other receivables, if there's any money owing, like rent prepaid, and also a supplier age analysis as well to show exactly what the suppliers, how much is due per supplier, that how much is due, etc., etc. And most importantly is the tax computation and how the tax has been arrived at. Because the amount that sits there is the amount that you should make sure that you put away so that you can pay your provisional tax on time. So that is just a basic overview of management accounts. These notes now relate specifically to the income statement. And usually the accountant would then make some notes and observations and some recommendations in the management accounts and give you some advice when they produce the management accounts for you. Right, what is the difference between the different reporting standards that I mentioned? I said those management accounts were produced on what we call the tax or historical cost base. Now, the tax or historical, there are two different reporting standards that most accountants would use for management accounts. So we've got the tax, or sometimes called the historical cost base, and then we've got IFRS for SMEs, or International Financial Reporting Standards for SMEs. Now, the tax or historical cost base, the profit with the addition of disallowable expenses is the profit on which tax is payable. So when you look at management accounts and you see your profit on those management accounts, if they're being done on a tax or historical cost base, that is pretty much the basis on which you're going to pay income tax on. However, that's not the case with IFRS for SMEs. Now, IFRS for SMEs are mostly attributable to companies, and it is much more costly for accountants to produce management accounts or annual financial statements using IFRS for SMEs, because they would need a lot of your input in fair valuing the assets. So IFRS for SMEs is basically providing management accounts, or the balance sheet in particular, at fair value. In other words, today's market value, as opposed to the historical cost that you originally paid for it. And as a result, the company profit does not equate to the taxable profit. So there are many reasons for that. So the tax profit is adjusted by non-taxable accounting entries, and there are some of the entries that the accountants would have to work with you as the business owner. They would have to fair value revaluations of significant assets. So if, for example, there's a building that the business owns, that building would be revalued. There would be impairment of assets and inventory. That is where the assets are sitting in your books of account at a higher carrying value than market value. They would have to write down those assets. They would need to fair value your income, your revenue. Also, when it comes to fixed assets, they would look at it from a component approach. So let's say you've got an aeroplane, and you are a skydiving company. That aeroplane they would need to value the engine of the aeroplane, the wings of the aeroplane, the internal part of the aeroplane, and each component would be depreciated accordingly over the useful life or residual values of the asset. Then provisions for non-tax deductible expenses needs to be provided. And of course, with all these differences, it raises what we call deferred tax calculations on timing differences. So you can see that reporting in terms of IFRS for SMEs becomes quite more complicated. And of course, your accountant will assist you with that. But it's important to understand when you do get management accounts on what basis those management accounts have been prepared. Right, critical performance key indicators that you need to assess when you have management accounts. The first is turnover. Second is gross profit margins, which we saw in the example earlier. Net profit margin, cash outflows, and cash inflows. So here's an example of turnover and a critical performance key indicator, where I've taken those management accounts we saw earlier. I've just looked at the turnover month for month for month. And what we do is we have a look and see if we use the first month as the base month, which is March, using that as 100%. We then look and see what the increase of the turnover in percentage value is. You'll notice in April, it dropped below March. It could be because of all the public holidays we find in April, or it could be for other reasons. But then you'll see that it eventually, the turnover percentage does grow month for month for month. Then we look at turnover trends, and this is something to analyze, the change in turnover in rand value. So between March and April, we had a decrease in turnover, which is not a good sign. As I said, maybe it's because of public holidays in April. And then we compare April and May. And if we have a look at that, we see that the turnover now has increased. It's increased very marginally between May and June. And then in June, July, it's increased quite nicely again, and it's come down again in July and August. So we then apply a percentage to those changes, and these highlights are red flags for the accountant to say, hang on a moment, what is happening? Why is the turnover only going up 1% here, come down here, and it's only 8%? So there's something happening in this business that is showing us that we need to look a little bit deeper as to why the turnover is going down. And it could even be marketing issues. So, sorry guys. Okay, then we look at the gross profit margin, which is a very critical factor as well. So gross profit margin is calculated as a percentage of gross profits as a percentage, sorry guys, over turnover. So you'll see that this trend is not very good. We start off at 37%, going down to 27% and up again. And then we go down 35 and 39%. And because this is a service industry, we are selling employees time. And it could very well be that there is an issue with productivity with employees. And we would have to drill down to find out exactly what and who the cause is. Then net profit to turnover as a percentage. Now, net profit is profit after all your expenses. And we look at that as a percentage of turnover. Now, when we look at net profit to turnover, we need to normalize the accounts. And to normalize the accounts, I mentioned that directors' remuneration was just, I think it was 10,000, if we remember correctly, under cost of sales. And because that is not a market-related salary for a director in the business, we need to normalize the profit by giving the director an additional salary, which is more market-related. So what we've done is we've taken the profit and we've added on the director's salary or remuneration in addition to what we've already paid him to normalize it. And now we see a completely different situation in this company, because now we see that the company, in effect, is actually not making a profit. It is actually making losses. And that is something that the accountant and you as the business owner would need to address. So the cash flow statement, we analyze the cash flow, and we find that, as I mentioned earlier, that because the director is not receiving a market-related salary, he's actually drawing out more money than the business can afford. So we're now landing up with a situation where the company doesn't have the cash resources in order to finance its growing customer base, because now it's gone into a bank overdraft, and this is a red flag because we would probably need financing and we would need to change this business around. So the critical performance key indicators is turnover is increasing, which is good, but at an erratic trend and a decreasing rate, which is not good, it's bad. The gross profit margin is erratic, not within the service industry norms, and net profit after expenses is increasing from July, but when we normalize those profits, this business is actually in fact making trading losses. And the cash flow decreased, resulting in a previous positive bank balance going into overdraft as a result of the director's cash drawings in excess of salary. Right, our next webinar, we're going to be covering business financial analysis. It's going to be on the 20th of September, again from 9 until 10. And we will be covering information you need to make critical decisions and also a better ability to understand financial data in management accounts. Shane, I'm not sure if there are any questions. In terms of tax law, those assets of crockery and cutlery may be written off in one go, and the amount that SARS allows is under 7,000 Rand per assets. So yes, one would in fact write them off, and from a management account point of view, in order to provide a more accurate and complete presentation of your management accounts, your crockery is very much it's breakable, and obviously, you know, it's not necessarily going to last for 12 months plus. So we would regard it as part of cost of sales, and part of your cost of sales, and it would be expensed immediately. I hope that does answer your question. Thank you for your question, Rickers. And the reason for that is for the evaluation purposes of your business. So the example that we saw earlier, and this happens a lot to small businesses, is where the business owner still needs to maintain a certain lifestyle and has certain personal commitments. And if they are drawing more money out of the business than the business can afford, and decreasing their loan accounts to the extent where they in fact land up owing the business money, you have what we call an insolvency situation, where you actually, the business will go insolvent. So it is important that the market-related salary on what that particular business owner is living on is paid as a salary, and so that one can actually measure the real true solvency and liquidity of the business. And also from a valuation of the business point of view, it needs to be normalized as well. I hope that answers your question. Proprietor running 2 companies under my name, can I compile these financials together, or would they need to be presented in separate set of financials, even though I'm a sole proprietor? Okay, so you're running 2 businesses, I would imagine, not companies, under your name, and it's difficult to really say if those businesses are completely different types of industries, or whether they are very similar types of very similar industries. So if they are very similar industries, yes, you can definitely consolidate the 2 trading accounts into one. That should be absolutely no problem at all. For management account purposes, though, I would certainly separate those businesses so you can actually see how each business is performing. If they are completely different businesses, so let's say maybe the one is a catering business and the other one is a construction company, then I would certainly not consolidate the 2. I would certainly have 2 separate financial statements for the 2 different types of businesses. And that is because from a tax point of view, you are in fact running 2 very different businesses, and they're completely unaffiliated with each other. And sometimes what happens is people try and carry a massive loss-carrying business and use that against a profit-making business. And in tax law, there's a thing called ring fencing, where losses are ring fenced in certain instances. So if the businesses are completely different to one another, then you would need to separate those 2 businesses. I hope that answers your question, Janet. If the director draws money to a debit loan balance, and they don't want to pay themselves a market-related salary due to not wanting to pay more PAYE, what would you advise? Okay, very good question, actually, because we see a lot of this happening in small businesses. The answer to that is when you have a situation of a debit loan account where the directors owe the business money as opposed to the business owing the director money, if there is retained income in that business that is greater than that debit loan account, then we have what we call a situation of a deemed dividend in terms of tax law, which means that 20% dividend withholding tax needs to be paid on that debit loan account. Otherwise, the only other way to circumvent that dividend withholding tax is to charge interest on that debit loan account. Now, that is counterproductive, hugely so, because the director is going to have to pay an official rate of interest, which is going to accumulate year on year on year. And eventually that director, on liquidation, if anything happens to that company, has to pay back that money in one lump sum. All money's owed back to the company. So it's a very risky situation to be in than trying to avoid PAYE. The other situation could be where there is not enough retained income to cover that debit loan account. When that happens, the company is insolvent and the directors have to liquidate the company. So it's a precarious situation that no accountant would ever recommend a director or shareholder gets themselves into, rather pay the PAYE. In addition, when you do pay PAYE, it is a salary, and if that director in their individual capacity want to get a loan for whatever they might need, they need to prove their salary. And if they're not receiving a salary, they have no basis on which to get financing personally. So having any debit balance and not paying PAYE and receiving a salary makes really no business sense at all. I do hope that assists in your question.